Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. I'm your host, Jeremy Dyer. Looking forward to this conversation today. I've got Adam Link with me today. Adam, welcome to the show.
Thank you very much for having me. Look forward to this.
Yeah, absolutely. Looking forward to chopping it up with you. So Adam is really in the financial advising space, and really what's called comprehensive wealth management. Definitely looking forward to diving into this conversation with Adam. He is not directly correlated with Wall Street investing only. He's able to advise clients on alternative, investment options as well. He's got a history with Coinbase. He's got history with managing and owning really real estate, commercial real estate assets. So you've got a great background. And one of the greatest things about Adam is he is located in northern Minnesota, a little town by the name of Virginia. We call it the Iron Range here. I only know this because number one, I live in Minnesota, but number two, I've got children that play hockey. And so we regularly find ourselves up in northern Minnesota for hockey tournaments. So Adam, really appreciate you being here and would love for you to let our listening audience know a little bit more about maybe yourself, your background, your journey, what you're focused on today, etc.
Yeah, certainly will. Great introduction. I am on the Iron Range in northern Minnesota. We've got a great hockey culture up here. So I know we were talking about that, and most people don't know where I live, but if you play hockey, you know where I live. Yeah. So what I do right now, I'm a financial advisor at a company called Fireweed Capital that I founded back in 2022. The goal of Fireweed Capital is to help up and coming families manage and grow their wealth. So one of the things that we look at is how can we best navigate the journey through the markets, through the various economic cycles, and how do we help individuals use their wealth to get the goals they want in life? I mean, at the end of the day, your money is just a tool to get you where you want to go. No one wants to be a millionaire. Everyone thinks they want to be a millionaire, but once you get there, you go, well, what am I a millionaire for? Right? Once you reach those financial number goals, it becomes about more than just the number. And so we really focus our comprehensive financial planning on what do you do after you hit the number? What does your life look like? That's what we do. I love doing it. I love helping clients, kind of figure out where they are today, where they want to go, and how to get there.
No, I love that. And I appreciate that you giving us a little bit more information there and kind of your backstory. You mentioned managing the cycles. I love this topic of conversation because it really separates the wheat from the chaff, as it relates to investing. You've got a lot of, we'll call it speculation, we'll call it emotional investing, we'll call it riding the roller coaster. But whether you're talking about Wall Street investments or Main Street investments, they all tend to go through, almost to a certain point, predictable market cycles. Of course, nobody has a crystal ball, so we never know if we're going up or down in that cycle necessarily. We certainly have the rearview mirror, so we know what happened in the past, but it's very difficult to kind of predict the future, right? So I'd love for you to kind of let our listening audience know a little bit more about, kind of how you as an investor or how you advise investors really to navigate the market cycles.
Yeah, so our investment philosophy is kind of based on two key things that are academically based. The first of those is we don't do passive investing. A lot of financial advisors love the phrase, it's not timing the market, it's time in the market. And fundamentally, we actually disagree with that. So we believe that you can look at the market and you can find patterns. And while you said, you're not right every time, and I fully agree with that, we're not right every time. But what we see is we think you can detect signs where the market may go. So for instance, there may be economic challenges ahead. We look at it as like if you're driving and you're driving down the highway and the billboard above the highway says accident ahead, right? There might be an accident ahead. It might be cleared by the time you get there. There might not actually be an accident there, or there could be a wreck. And what passive investing asks you to do is stay on the highway and figure out if there's an accident. Whereas our strategy is active risk management. We say we're going to pull off and we're going to find a new route. Now, is that route faster? Sometimes. Is it slower? Sometimes. Was there an accident? Maybe. But we went and we charted a different course around that accident. And that's really what we think a lot of investors need. And certainly, if you're looking at real estate as well, what people want when the market gets choppy is to do something. And academic study after academic study shows that the average investor gets 1 to 2 percentage points lower return than the index. And the reason for that is because when the markets get choppy, they want to do something. And most individual investors choose the wrong time to sell. They sell at the bottom, they get scared. And so what we do with our clients is sit there and try to make sure we don't sell at the bottom. We try to manage the drawdowns, right? And we try to capture some of the upside. So what we do is we try to do something. Is it always right? No, but we're helping our clients basically with that fundamental human need of I got to do something. Who do I call? What do I do? And we do it the best that we can.
Yeah, I know that makes sense. I'll never forget during the global financial crisis, I picked up the phone and I called my financial advisor and I said, "Sir, what do I do now? The market is falling. I've gotten a 50% haircut, on some of my stocks that I was owning in my portfolio." And he said, "Jeremy, I'm literally hiding under my desk." So it was that point in time where I realized, you know what, maybe the financial advisors aren't one size fits all, kind of a thing out there. And maybe I need to take more active and aggressive ownership, of the actual, types of, activities that I'm making, on a day-to-day basis as it relates to my own, personal investing thesis. So I would like you to maybe talk a little bit about this kind of concept of, I'm going to call it set it and forget it. I know there's a big kind of push towards people saying, hey, forget about the financial advisor, forget about the wealth manager, just invest in an index fund and set it and forget it. What's your thoughts?
Yes. So set it and forget it investing actually comes back to a kind of joke amongst the financial industry. But do you know who the top two types of investors are every year? It's people who are dead and people who've forgotten they have an investment account, right? And what does it tell you about set it and forget it investing is that you really have to forget it for it to work. And the only way people usually forget it is they actually forget they're invested. Anyone with any sizable amount of money, you're not going to forget where your 401k is, right? And if you're not going to forget it, the idea that you're going to hold on through all these ups and downs equally well is really expecting way too much out of an individual. So we don't think set it and forget it works, right? Because set it works great. Forget it is hard to do when you said, you're down 50% because you're not forgetting it. So we actually have developed a quiz that we use on some of our folks where we say, here's what the market's doing. Do you stay in or out? And the punchline of it is the very last day, the worst possible day, when most people say, I'm out. The next day, the market has the biggest gain in a decade, right? And so everyone who said, I'm out at the very last, they just locked in. I think it's like a 25% drop in our scenario. And you know what? A financial advisor is going to cost you way less than a 25% loss in your portfolio. So that's our view is, what? Set it and forget it doesn't work because people don't forget.
Yeah, that makes total sense. And people definitely remember those losses more than they remember those gains. The pain of a loss is much significantly greater than the pain of a gain. So I've heard from the psychologists. But, I know that you've got a lot of substantial investing experience, in everything from stocks and bonds to apartment units to you've done, angel round VC backed investments. You come from Coinbase, so you've got exposure to, I'm sure, to cryptocurrencies, given the fact that you've spent, time with Coinbase in the past. So would love for you to let our listening audience know a little bit more about, like, listen, what's the right portfolio balance, for that, I'll call it that average, higher net worth individual. Maybe they're crushing their W-2, year in and year out. They've got a few kids. Maybe they're in their 30s, 40s, 50s, right? So they maybe still have 5 or 10 or 15 years left the runway, to continue to chase after that corporate W-2. What would you tell that type of an individual, as it relates to what, really a kind of a balanced, portfolio construction would look like today?
Yeah, great question. I think it really comes back to what do you want your money to do for you? and how much risk can you actually take? So, like you said, I've done all sorts of investments all across the risk profile. Cryptocurrency, folks have talked about crypto for many years. 10 years ago, it was a way to go from someone who's broke to a multimillionaire. Today, where we are now in 2026, I don't think there's any crypto out there that has the possibility to take you from $100 to 100 million. I just don't think we're there in that market cycle anymore. So when you look at your individual portfolio, what do you want? Well, ultimately, it comes down to what is your money going to be used for, right? You got your short term money that you need in case you have to buy a new car tomorrow, right? And then you've got your money for, well, maybe I'm going to go buy an apartment complex, or I'm going to try to get into a passive income stream. And then you got your money for, well, I need this once I'm 65, or once I've decided to retire and I'm doing the substantially equal periodic payments out of my 401k, right? It really comes down to when do you need the money and how much of the money do you need, right? So if you want to go into something like a hedge fund and try to get 20% per year, that is a very risky investment. You lock up your money for 7 to 10 years, but if you don't need your money for 20 years and you're sitting on a couple million, that might fit your goals, right? I've done angel investing where I've lost all the money. I've done venture capital investing. I've got money locked up in companies that I hope they sell. I hope I get my money back, right? But I don't need it. I don't need it for another decade or so, right?
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Yeah, that makes total sense, and I've been there as well. So you're either kind of sitting back, hoping that there's a liquidity event and your original investment goes to the moon, but you also go into it knowing that it might be a complete donation. So I have personally been there myself and totally can sympathize with you. When it comes to financial advisors and wealth managers, you've got kind of some that really drive this tax abatement or tax strategy. And then you've got others that are kind of more performance based driven. What would you say is kind of that, balance between, focusing on, tax efficiency being the ultimate strategy versus, maybe more that are more performance, focused?
Yeah, I think it comes down to your mindset around your ability to earn. If you are in a mindset of, for instance, a W 2 employee who's not going to get promoted, who only has a set amount of money coming in every year, and you only think you're going to get that amount of money coming in every year for the next decade or so, really your best bet at that point is let's start looking at tax efficiency, right? If you can't grow your pie, you want to keep as much of the pie as you can. However, if you're even in a W 2 and you think, well, maybe I can get promoted, maybe I can work a little bit harder, get a bonus, maybe I can use my weekends differently, maybe I can get a second stream of income. Well, then tax isn't the problem, right? At that point, we're looking at performance. How can I get more money for my time? And so if you're thinking, I'm going to grow the pie, performance is the thing to be worried about because ultimately you're going to pay taxes. Taxes exist as a way for you to support society when you have income. The more you pay in taxes, the more income you make. And so you can either focus on paying less to the government and ignore your revenue growth, right? Or you can focus on growing your revenue and taxes will fall where they fall. For me personally, I like the performance side. I think it's much better to have an abundance mindset and say, sure, I might be making $100,000, $200,000 today, but why can't I go get promoted another 2 levels and make 150 or 300,000, right? Like that's more fun for a financial advisor to work with you on than saying, well, how can we get another $1,000 in taxes, saved? Because honestly, those don't matter. $1,000 doesn't matter if you get $100,000 raise, right?
Yeah, it makes total sense, and I appreciate the contrast between kind of tax strategies and performance based, investing and how they can complement, one another. But I also think about, on the performance side, right? Everybody likes to have their investments perform, but there's also this potential for that downside, right? And so, how is it that you advise clients on really, protecting, that downside, and maybe that is or is not through a dollar cost average approach?
Yep. So one of the things that we actually look at in our investing strategies is how do we protect that downside? Because the downside really is where people make the bad behavioral decisions. They get scared, they sell, right? Or they're worried, they can't sleep. And honestly, quality of life is just as important as having money, right? And so for us, we really do look at downside protection primarily. And what we want to miss is we want to miss the very bottom of the market. And what that usually means is we're also going to miss the very top. And for us, the trade off of not losing is where we want our focus to be rather than outperforming the market. Because actually, when you look at the numbers, if you don't lose, you start at a higher baseline that next cycle. And so you can actually outperform your benchmark over a period of time by simply not losing as much and starting that next cycle at a higher footing, right? You don't actually have to beat the benchmark every year. So that's one of the things that we've looked at academically, and we've said, okay, this is what works with human behavior, and also actually produces, in most cases, superior returns.
What are your viewpoints on kind of this? I'm going to call it the AI revolution, okay, which is radically transforming SaaS-based software organizations. It's radically changing the cryptocurrency industry. It's really, I mean, from anything from retail to uh, you know, global travel, right? It's changing every single industry. So I'd love to kind of get your viewpoints as to, is AI here to stay? Is it going, should people be concerned about, the jobs being reduced over time? What's kind of your take on the whole AI revolution?
Yeah. So you can't see my desktop right now, but I actually have three separate AI screens open right now. So we are heavy users of AI here at Fireweed Capital. When you look at the corpus of knowledge that it has and what it can do for you, AI really does allow us to operate as a much larger firm without having the staff required to be that size of a large firm. So my take on AI right now, I think that we are going to see large companies realize that they need fewer employees. There was a research paper that came out about a week ago now that basically called for a downward spiral over the next 2 to 3 years in white collar profession. And I do think that that is likely going to happen. I don't know to what extent, but I think we are going to see knowledge based professions get replaced by an AI that's able to remember more, do more, right? Not forget the rules that we all forgot in business school, right? Like I don't remember some stuff from school, and AI remembers that. So it's going to know more. And in a knowledge-based profession, it's a scary place to be because you're basically paying for your knowledge. AI knows more, it's going to beat you, and it works for nothing. So what does that mean for these large companies? They're going to lay off folks, I think. Now, where do the laid off people go? I think this is the silver lining, is we have seen time and time again tech disruptions change our economy, but people are generally not left behind forever. I think you're going to see a bunch of knowledge-based workers suddenly realize that they and a friend can start to hit above their weight and act as a much larger company with some AI assistance. So I think we're actually about to be on a golden age for startup companies. Right? Folks that used to work out of their garage will now be two people working out of the garage and acting like a 20-person company because they have AI. So I think that's actually going to be very positive for Main Street. I think it might help us revitalize a lot of our economy around small business. And certainly it's encouraging me to put a little bit of a nicer finish on my garage because I might be working out there. So no, I think that's kind of where we're going to be going through it with AI.
That makes total sense, and that would be a great thing for small business and Main Street, USA across the landscape of this country. And I even think about how AI is, to your point, enabling that small entrepreneurial type individual to really compete with the big corporations out there, right? So almost kind of allowing them to really level up, in that general sense of imagination there. So I'd like to also maybe get your kind of feedback or input on what I like to call the inflation monster. Okay. Everybody likes to talk about this nest egg. I never forget, when I was a high schooler, I thought, man, if I could just have $1 million, okay, I would be able to retire and do what I want, golf, fish, hunt, whatever I want for the rest of my life, right? $1 million isn't a lot of money anymore today, right? So that goalpost has moved. And a large part of that is because of inflationary pressures. I tell my kids who are teenagers, I say, listen, when I was your age, I could get a McDonald's value meal for $3. Today, that same value meal costs over 9. right? And that was the stretch of a 30-year period. So where do you think the McDonald's value meals are going to cost in 30 years from now? They're going to be 27 bucks, statistically speaking, right? With the inflation monster. So how do investors protect the nest egg, from this inflationary environment?
Great question. And it is something that affects all of us. Inflation is never going to go away. It is a feature of a monetary system. It's not a bug. And actually, inflation is required a lot for our growth in our economy. What you see happening in inflation is there's kind of two sides, right? The first is the value of goods you can get. You generally see goods becoming higher quality for cheaper. And you can see this in like computers, for instance, right? A computer used to cost a whole ton of money. And now we have a cell phone that ostensibly has more computing power than what we used to put a human on the moon. And people put them in their back pockets and they drop them in the toilet all the time and nobody cares, right? Like you didn't drop the, NASA space program in the toilet, but yeah, 50 years ago it was like that, right? So now it's whatever, it doesn't matter. I think that that's going to continue where we will see the goods that we are getting become better. But I agree, they will cost more. And sitting here today, would I pay 27 bucks for a Big Mac? My gosh, I mean, no, that's wow, that's gonna be a really nice burger. $27 today buys you a really nice hamburger, right? So how do you keep ahead of it? And I think this is the one thing that I think about as a financial advisor is what's your escape velocity? So escape velocity is basically the point at which your investments are returning enough money to stay ahead of inflation. So if you get a 10% return on $100, you've made $10. Congratulations, that doesn't actually matter that much. 10% return on $1 million is $100,000, right? That's enough money that it actually matters. So the trick here is how do you build your base fast enough, aggressively enough while you're young, that by the time you need to take money out, you've reached that escape velocity where your portfolio still grows faster than inflation is eating away at it, and your dollars you're taking out also grow fast enough to beat inflation, because $100,000 in income today may not be bad, but over a 30-year retirement from 60 to 90, $100,000 a year is going to buy you substantially less by the time you die, right? And healthcare is going to be a lot more expensive. So there's a mathematical formula you can run basically to figure out what that escape velocity is. But when I was younger, I figured out how much a pizza cost me once. I took the future value of my money invested in a pizza, and at the time I was in my mid 20s or so, it was something like 10x the cost of a pizza is what it actually cost me in expected future value, right? So is that really a $200 pizza you're getting from Domino's? Right? And that drastically changes the way you think about things, changes how you think about consumption when you're young, right? And that's really the mental model you got to be playing at is, how much can I save as quickly as possible to reach that escape velocity? And if you don't, you're going to get eaten by that inflation monster. There is no ifs, ands, or buts.
Yeah, makes sense. And Adam, this conversation is fascinating, but before we kind of wrap up here, I want you to give our listening audience just kind of one what is the next step, right? So somebody listening today, what's that next step that you would advise that individual, to take a step in a different direction that maybe they historically, hadn't really thought about from a mindset perspective?
Yes, I think that's great. I think one of the things I would leave your listeners with is this idea of what am I trying to achieve with my money? And that is really the thing that underpins everything else. If you are trying to take your money and 10x it in a short period of time, you have to be ready to stomach losses and risk like no else. But if you're sitting there on a couple $1,000,000 and you say, all I need is just to make this grow a little bit, all I want is to not lose my millions, that is a very different way of investing. So you've got to take a look in yourself, know what your goals are. And that is really what is going to drive your entire investment profile moving forward.
Yeah. So a big takeaway here is before you ever make any investment decisions, make an investment in learning and your own knowledge, right?
Exactly. Yep.
Great. Well, makes sense. Adam, this has been a remarkable conversation. Thank you for really bringing the northern Minnesota heat, if I could even say that, to that conversation here. What might be maybe one or two different ways that our listening audience can connect with you offline to learn more about what you're up to?
Yeah, certainly. So you can go to our website, fireweedcapital.com. or you can email me directly. It's adam@fireweedcapital.com. I answer every email I get, and look forward to chatting with folks when they write in.
That sounds great. Well, again, thank you, Adam, for the value that you brought us today. And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.